Mark, it's been a good start for Indian markets this year. But are you somewhere surprised, and honestly very surprised, that nobody is talking about the inflation print which has come for US market? Even the US bond market, in a sense, have not sold off.
I'm not surprised because it was bang in line with expectations. 7% headline was what the consensus was forecasting. And everybody knows inflation is bad now, and what people care about is if it's going to be bad later. And I think that it will get a lot better. Half of inflation, broadly speaking, I think could be considered sticky, given that real estate is over a third of the CPI basket in the United States, and they have a big supply-demand deficit. It's anywhere from about 3.5 to 5.5 million homes of imbalance between supply and demand. So that's a problem. But durable goods are a big part of the rise of inflation, and we think that is transitory. It's COVID that caused the massive purchases of durable goods because people were stuck at home with nothing to do. They couldn't go out and spend their money on hotels or restaurants. So goods in the US household purchases went from about 60 to 70%, and services went down. On the other hand, you had the supply chains all disrupted because of factory closures and port closures, and the container fleets slashing their routes. So what I want to say is that if Omicron is the last phase of the pandemic, which we think it is, and it could still be bumpy because frankly it hasn't really moved into Asia in a big way, so there could be some supply chain disruptions over the next month. But if we can look beyond that, which I obviously think we should, and we can see in the data from South Africa and from New York and from London that it's highly contagious, but it's not as deadly, and then it fades very quickly. I'm trying to say that we think that the inflation numbers 6-month forwards will be much lower than it is today. Therefore, I'm not surprised the street is so sanguine on it.
So Mark, that means you are convinced that somewhere the world is facing a supply crunch. It is not like a excess demand which is getting created.
Excess demand was created temporarily because of people staying at home with nothing better to do than spend their stimulus checks, but they're not getting the stimulus checks anymore. And I think they will go out and spend again in restaurants and hotels, but that's a lot less inflationary, in part because services are something that's very scalable, particularly in the digital age. You can watch a Netflix movie once, or you can watch it 1,000,000 times. It doesn't really cost Netflix a lot more money. Yeah, I don't think that inflation is the big bugbear it's being made out to be. Now, the Federal Reserve is talking hawkish because it's a very sensitive issue socially. Nobody likes paying a lot more for things, and they have been doing that for the last 7 months. So the Fed is talking to Main Street now rather than Wall Street, conveying a message that it's aware of this, that it will react to this. But I think it knows that the inflation rate will come down, and so it will be less hawkish than it might appear to be on the surface.
That's right. Let's see what the Fed actually does and walks the talk. We've already started hearing the likes of, Jamie Dimon, for example, saying just 4 rate hikes this year. Good morning, Mark. The question also then is, and I would love to get the India impact from you. You talked about how everybody was writing checks, and there was so much liquidity. But given all of this, what is it going to mean for India as far as flows go?
I don't see things being radically different. And all I see really is that people would like to have some global diversification. And for the last 10 years, they found that in China mega cap consumer technology names. Those could have their time in the sun. They're awfully cheap. They've gone down a lot. But I think at least for the next 6 months, China looks in pretty tough shape, both in terms of its economy and in terms of the anti-monopoly policies of the government and the impact on those mega caps. So I'm trying to say, in the absence of China, people just they start going down the list, and there's obviously dozens of emerging markets. Most people don't want to get too small because they just don't have the time to look at all these little countries in Latin America or Southeast Asia. So when you go down the list, you get to India, and I think it's the next largest emerging market after China, and therefore, I think you're probably going to see continue. No, you didn't see much inflow into. Take that back. Continued. Didn't have any inflow into India last year from foreign investors. I can't really say why, but I think it looks attractive, and I think the message should gradually get out there, and people should buy it.
Mark, considering you're a keen observer of the Indian market, I just wanted to understand when it comes to the Indian IT services sector in specific, because we're not a products IT sector in that sense. Wanted to understand what your view is, because we've left behind an excellent 2021. Going forward, while valuations and the multiples that some of these stocks are trading at may not be able to justify the growth numbers that they're going to, keep posting, and there is that impact of base effect as well. But purely from an investor point of view, do you sense that one needs to stay put and stay invested in Indian IT names?
I think so, but I think within IT, in India and globally, there is an important differentiator, which is earnings or cash flow. And the companies that don't have it, but were really high-flying companies because rates were at all-time lows over the last couple of years, and fit in very well to the COVID themes of staying at home and things like that. If I said, a Zoom or a Robinhood or a Snowflake or there's a lot of these companies that have very good stories, but not a lot of cash flow behind them, and those are the ones that probably won't outperform, but the ones that particularly are hitched to the cloud computing and artificial intelligence story, and those are themselves two sectors that are completely intertwined, because you need cloud computing in order to have artificial intelligence. But that is something that's becoming mainstream in our lives, in our businesses, as we use big data to analyze and make choices and prevent theft of identity, bank accounts, etc. Anyway, I'm trying to say that within India, I presume there's something similar. There are the conceptual stories that don't have a lot of cash flow, and then there are the ones that do artificial intelligence and cloud computing, and I think several of the big blue chip IT companies in India do just that. Those ones I think can hold up and continue to outperform, because those are, we think, two of the major themes for the next 5 years. In America, it's the FANGs, but in India, I think it is, your big blue chip tech stocks.
That was something very interesting, Mark, considering IT and banking in that sense are going hand in hand. And, what you talked about as to how conceptual names are going to do better. One can see that play out within the Indian banking sector as well. While it's just about begun participating in the market rally, there is a very diverse move on each and every stock. I mean, you could also attribute that to the underperformance that banking has seen, the valuations and growth trajectory, etc., of many banking companies. But again, does that stand true within Indian banks also, that not all of them will be able to go home winners?
I think that the driving force behind bank share price performance should be the health of their balance sheets. And broadly, I think the sector has done a lot of healing, and the economy, I think, ironically, entered an upswing around the same time as COVID arrived on India's shores. So last year, as horrible as the Delta wave was probably the beginning of, I think, a few years of very strong economic growth. And that would be reflected across the board in the banking sector. So the old story with the banks is you wanted to be in the ones that had the strong balance sheets, the private sector, with the capacity to lend, while the public sector banks were crippled with their non-performing assets. I think now it's possibly a broader sector recovery, just premised on the economy doing very well this year and next, and probably the year after next as well.
So are then those the two big themes for you? Are big chip IT companies and the financials?
They are sectors that we like. I don't think they're the only ones. I've found that it's very, very difficult to pick sectors, not only in India, but just globally. 85% of actively managed funds underperformed the S&P last year. But in a way, those two sectors, if one wants to pick sectors rather than just broadly invest in the market, would be the way to go, because the banks give you the cyclical exposure, and then the blue chip IT give you that kind of structural digital revolution exposure. So to answer your question, yes.
You know, we love to know what people like you like, but it's also very important to know what you don't like, right? That's also a good way to assess the market. So can we come to that? What would you sell in this market?
Well, I'm cheating by not giving you a straight answer, but I'd just say, to reiterate, that it's very hard to pick sectors right now. And so I think I'd like to say, for example, that the fossil fuels don't have a very bright future, which I don't think they do on a 10-year view, but their share prices have just broken out. And so there's the short term and the long term. It's all difficult. I can't really say there's anything that I really don't like, except to come back to what we talked about earlier. Those high-flying tech companies that really don't have any substance in their profit and loss statements will struggle, I think, this year, because rates are going to be drifting up in America, and there will be a continued repricing of those conceptual companies whose earnings are only in the very, very far future. So that's what I'd say.
Mark, do you see a market like India decoupling from the US markets? Because if you keep S&P aside, frankly, a lot of US tech stocks are down 25 to even 50%. The breadth has been quite anemic. We've seen a risk-off rally in a lot of internet stocks, a lot of retail-dominated US stocks. Do you see a situation that, barring the near-term adjustment, we could see a 2022 where India or emerging markets do rather well and US markets give you precious little returns?
I don't see that, actually. I think it's still going to be a good year for the US. It won't be like last year. Last year, the US and India performed almost exactly in line in dollars, including dividends. This year, I think they will also, but instead of getting a return of 25%, more likely something between, I'm just picking numbers out of a hat, but if I said 7 to 10, and unfortunately India already up this year about 5, but I think that's because of the December sell-off. So I would remain invested in India and add if I didn't own it, but I wouldn't expect it to outperform the US, because the US has those FANGs, which I think are going to do well, but it also has huge cyclical exposure through financials and other sectors related to the economy. And I don't see why India should do better than the US, but I think it can trade in line with the United States.
Mark, we all know that interest rates will go higher. We all know that liquidity will get tighter. But how much are markets really pricing it in? So what is that quantum of liquidity withdrawal and what is that quantum of rate hike is something which is already baked in terms of the market levels and in terms of portfolio positioning?
The one that's very hard to know is what the impact would be on financial markets of the Fed shrinking its balance sheet, which it's talking about doing sometime this year. But we do know from prior experience that when they did that in 2018, all financial markets were down, treasuries, high yield, and share markets. And so this is the risk, is that the Fed is communicating it does intend to shrink its balance sheet. We know from prior experience the market doesn't like that. I would simply say that we think they're going to be much less aggressive than they're making out to be. And to circle back to what I said earlier, because we think that the Fed in its heart actually knows that inflation is transitory, but it sounds heartless and cold and like you're living on another planet to keep using the word transitory when we've had 7 months of very high inflation and the politicians are getting leaned on a lot, including President Biden, for this high inflation rate. So it has to talk hawkish, but I think that if the inflation rate does come down, they will not shrink the balance sheet as fast as they're communicating or as soon. And the impact on the financial market, therefore, won't be like in 2018. It is a risk, though. So I think it's the major risk this year is the Fed actually does shrink its balance sheet. That would be, from a financial markets point of view, a policy mistake.
Okay, point made clear. Mark, great to have you on the show. Thanks as always for taking the time out.
Thank you. Bye-bye.